The following is an encore presentation of one of many Financial Sense Premium programs which are available every week to premium subscribers only. For more information on premium subscriptions, go to our financialsense.com website and click on the subscribe link provided.
The Financial Sense Midweek Edition with Jim Paplava. Delving in-depth with authors and experts into the key economic issues.
Last year was a year of taking risk. No matter what the concerns were, whether it was the fiscal cliff, the sequester, or even the taper. Even though stocks dipped, they came back at higher levels. The risk-on game was the game to play. This year, things are a little different. The stock market's down, risk-off assets are doing well, and things aren't as rosy. It's the risk-off game. Joining me on the program is Felix Zulauf. And Felix, I'd like to begin with some of the views that you expressed in your Barron's article. A couple of them was that the world economy, in your opinion, is going to disappoint. However, the U.S. will perform best while China's economy is slowing dramatically. Let's begin with that.
Well, that's an important point because from the early 80s onwards, the U.S. has run ever-increasing trade deficits. And that changed only in the last great financial crisis. And since then, the deficits are getting smaller and smaller on a trend basis. And I think this is important because it meant that in the previous almost 3 decades, you had a situation where the U.S. was stimulating the world economy by letting the world take more and more of the U.S. growth. And since the great financial crisis, that has changed. It means that the U.S. is losing less and less of its own growth to the rest of the world, which is a negative for the rest of the world and a positive for the U.S. Now, this has obviously reasons, and the reasons that I see are 3. One is the energy production in the U.S. You are going through an energy boom in the U.S., which means you have to import much less energy than before. The second is that the private households are not leveraging up their balance sheets anymore as in previous decades due to the home price boom, and therefore the consumption is much more moderate than it used to be. And thirdly, you have, due to the declining U.S. dollars for more than 10 years up until recently, you have become much more competitive in terms of unit labor costs. And I think those 3 factors make the U.S. economy looking relatively best in the world. And I think the emerging markets in particular are feeling this change quite a bit. As you know, the numbers coming out of the emerging markets in general are disappointing. The emerging markets economies are slowing down. Some are actually in negative growth territory. And I think that is important for the world, but not for the U.S. For the time being, the U.S. looks solid and strong, and particularly relatively speaking, and very attractive compared to other places in the world.
You know, how much of this, Felix, has to do with the combination of not only the dollar, which has gone down over the decade, we're more competitive. You're seeing, when you read the papers, more companies are relocating here from foreign companies to U.S. companies. Our energy costs, like natural gas, are much, much cheaper than what you can find in Europe or in Asia. So a lot of people are attributing this to not only the energy and manufacturing renaissance, but another factor I'd like to get your opinion on, it's something that some people have called rovolution. In other words, the robotization of manufacturing, which gets rid of some of the labor arbitrage that we saw over the last 2 or 3 decades where companies would go to Mexico to find cheaper labor than to Asia. Do you think that's a factor?
Well, it may be, but I don't think it's an important factor at the present time. And companies, be they in Asia or Europe, so in other regions, they are using the robotization as much as the American companies are using it. So I don't think that's an important factor yet. It is an important factor for productivity, obviously, and for corporate profit margins, obviously. But I don't think it's a factor in terms of relative competitiveness because other regions are doing the same thing.
I want to talk about the fiat system that we live under now. You've got the Fed tapering and pulling back on some of its quantitative easing. You have quantitative easing around the globe. In your opinion, Felix, why do we not see inflation develop in the developing world where you're seeing more inflation in the emerging world? How would you explain that?
Well, we do have a lot of monetary inflation, and we had it for some years due to the money printing by many central banks. And the monetary inflation can show up in different ways. And the biggest booms we had in recent years was in emerging markets. And there you had dramatic improvement in the economies, and they went to a boom, and their economies enjoyed capital inflow from the outside, from all the monetization that went on in the U.S., for instance. So they enjoyed tremendous capital flows coming to their countries, and their currencies were revalued, and they didn't want it, let it happen to the degree it would have if they didn't intervene. So they intervened, and by intervening, they created domestic liquidity, and that domestic liquidity became a stimulus to the domestic economy. And so they had a consumption boom and an investment boom, and wages went up, and real estate prices went up, et cetera, et cetera. They went through a dramatic boom, and therefore they had the inflation that didn't show up with us. In our countries, in the developed world, we also have some inflation, but the statistics are probably a little bit strange, the way it's taken. And then we have import prices going down. If you look at U.S. import prices, with the recent decline in currencies in the emerging world, with the recent decline in commodity prices that we have seen over the last 12 months, that is a dampening factor for CPI inflation because those U.S. import prices go into the CPI with about 1/3 weighting, and therefore we haven't seen it. Then we have seen the monetary inflation showing up in asset prices. House prices have recovered. Stock prices have gone up. Certain prices in collectibles and art have gone up. So it hasn't shown up in the goods and services that the average citizen buys because the average citizen doesn't have enough money to push prices up much higher because the average citizen is still constrained. But it has shown up in many places, as I just explained.
When you take a look at the world as it is today, where you have, let's say, inflation problems in the emerging market, disinflation in the developed world, it's almost a different dynamic than what we saw in the last decade, where U.S. trade deficits were pushed out through the rest of the world. It took away growth here. We had higher energy prices when they got up to 148. In this period of time, when you had global growth expanding, as it did in the last decade. This decade, global growth has slowed down considerably. I wonder if you would relate that to the price of gold, because the price of gold did well in a period when the global growth was much higher. Now that we've seen slower growth, explain what has happened to gold. I think it's a mystery to some people with all this money printing, why it has not gone up much higher.
Well, if I knew all the answers, I would tell you. I think, first of all, gold has gone through a tremendous boom for 10 years, and it went up several-fold, and eventually overheated, and there were signs that we were at the cyclical peak. And I was expecting a cyclical correction. I was expecting about 1,500 on the correction and lasting about a year and a half. It has lasted over 2 years, and it went further down than I originally expected. I think what I described before is there are still a lot of deflationary tendencies around in the world economy. Growth is not enough, and debt is very high and growing, actually. And when you have highly leveraged economies that are not growing enough, you have certain deflationary pressures showing up in the system. And I think many investors who bought gold as a protection against rising inflation were disappointed that inflation didn't show up the way they expected. But stocks were running up higher, and so they started to switch out of their gold into stocks, into the performing asset class. That was particularly true in the Western world. Whereas in the emerging world, in China and India, the two biggest buyers in the gold market, buyers kept buying. And the gold changed hands from the asset allocators in the Western world to the long-term and steady buyers in the Eastern world. And I think in the Eastern world, you have to understand what gold means for them. In India, it's important to have some gold because for all the marriages, you need gold. Not every Indian has a bank account, and he stores his savings in gold. And the Chinese know quite well that not everything going on in China is solid and robust and going well, and therefore they want to have some protection, and they are buying gold. Last year, the Chinese bought almost the whole world production of gold, and thanks to them, gold has held up. So I think gold has had a cyclical correction. It has turned around now. I think it's going to be a sloppy turnaround. We probably have a run to 1340, 1350 on the current medium-term advance. And then we will probably fall back once again because we won't have rising inflation in the developed world. And we will probably have some relapse into a deflationary episode in the second half of the world. And markets are looking forward, and therefore gold will come back down. However, I think with a relapse into a deflationary episode, more and more risks in the global credit, economic, and financial system are going to come to the surface, particularly in the second half from mid-year on. And as that happens, I think gold will become more attractive as a protection against systemic risks. And I think the buying will increase in the second half, and I think we will see a much more solid recovery starting around mid-year, well into next year. And then we could easily see the 1500s. It will probably be difficult to break above the low 1500s, but we'll take that as it happens and one step after the other.
As we look around the globe, we began our discussion with the U.S., where you said there's a number of things going on. Increased energy production, private households are not deleveraging, and the U.S. has become more competitive, especially in manufacturing. Let's take a trip around the world. As we cross the pond over into Europe, in your neck of the woods, what does Europe look like to you? Will they solve this problem, or have they just kind of swept it underneath the carpet for the meantime?
Well, so far they swept it underneath the carpet, and successfully so, and the consensus opinion is that everything is fine and dandy. I doubt. I think structurally the euro is a severe problem for Europe because having the same currency, interest rate, and monetary policy for a vast number of structurally completely different economies is a very challenging thing. And I think the imbalances and stresses will continue to build over time. At the present time, it looks rosy. Mario Draghi has achieved with his word whatever it takes, that the markets have come down, that the markets believe that the euro will stay together, and everything is fine, and risk aversion has declined sharply. And as it has declined sharply over the last 2 years, since Draghi's intervention, 10-year government bond yields for peripheral countries like Italy, Spain, Portugal, etc., have virtually been cut in half. And that helps, of course, the economy. And people say, well, we have some deflation in those countries, and it's necessary to rebalance. And with deflation in those countries, so virtually no CPI inflation, and 10-year government bond yields above 3%, that makes for an attractive real yield. And with what happened in the emerging bond markets, where currency sold off and investors took a beating, those investors have been switching to European peripheral bonds, where they can get a decent yield in nominal and real terms, believing that everything will be fine and dandy. Now, they did believe that also in the emerging markets, where everything was not fine and dandy, and I think that will come back to the surface again in Europe. But it's very difficult to say when. At the present time, some of the economic leading indicators are slightly positive, like the PMIs, which is more a sentiment than a fact-based indicator. And what we can say is that Europe has stabilized at the low level, including the periphery at the low level. But I don't see the preconditions for a recovery, because for a recovery, you need the monetary preconditions in place. And I still see the monetary aggregates declining, the growth rates declining. I still see credit to the private sector shrinking at almost 4%. I don't think those are the usual preconditions one needs to see for a recovery. Therefore, I would become more and more cautious during the next few months. But at the present time, markets are running. The bond markets in the periphery are hot. There is a lot of hot money in it. A lot of it is American-based money that is flowing into Europe. And the same is true for the stocks. With bond yields declining as sharply as they did, obviously the belief that the economy will recover is strong, and therefore the value buyers have entered the peripheral equity markets, and they are buying a lot of Italian, Spanish, Portuguese stocks, and even Greece. And I think the biggest part of that money flowing into those markets is American money. And as usual, foreigners usually make the top when they come into a market overwhelmingly. I remember that in the 60s when the American money created the top in the European markets, and it's going to be the same thing. I cannot tell you exactly when, but I think in the next few months we'll probably see an end to this. My view is that the cyclical bull market is in a later stage. It's very overheated. It has become frothy. And at the same time, we see the tapering in the U.S. that will continue. That means that we are withdrawing step by step the stimulus that was propelling this bull market to the highs it is. And therefore, the environment for investors in the stock market is becoming more and more risky as time goes by.
Let's go a little further and let's go on to Asia. Can the People's Bank of China engineer a way out of their current mess?
Well, that would be great if they could. I don't have the final answer. I just think people should be aware that the investment and credit boom in China has been the biggest we have ever seen in modern history. And the numbers are mind-boggling. And we now see all the signs of a late stage of a credit bubble. We do not know when it will burst and how it will burst, but we know that we are in a late stage. We have all the classic signs that one usually sees, and we have now stress in the credit markets. We have money market rates popping up, and whenever the Chinese, as they decided at the third plenum in November, that they want to calm down investments to more normal levels, and they want to bring the ratio of investments in percentage of GDP further down to maybe 35% from 48, 49%. Whenever that creates a problem and stress in the money market, they have always, so far, thrown liquidity at the problem. Now, if you do that, you procrastinate and you postpone the bubble from breaking. Maybe they think they could do it in a controlled way. I'm not sure that's possible. With the dramatic size of the bubble, that's probably impossible. So I think we have to be prepared for some bad news eventually coming out of China, but it's very difficult to say when. We see some interesting things. We see that in the emerging markets outside of China, we see that foreign exchange reserves are being run down because they are protecting their currencies and they are tightening, et cetera, which eventually leads to a weaker economy. And we see capital flowing out. We don't see that in China. In China, it's still the reverse. We still see capital inflow and foreign exchange growing to some degree. And when we look a little bit more carefully at the numbers, then we see that it's most likely, we don't have all the details because it's very difficult to get detailed information in China. But it looks like Chinese corporations that are under stress are repatriating part of their money they hold offshore to fund the stress situation they are facing internally. So it is very similar to what we saw in the early stages of the Asian crisis when the Asian currencies in 1996-97 first strengthened because corporations brought their offshore money back home to fund the stress situation, and the global markets read that as a sign of strength. And it looks like the same thing is happening in China, whereas we think it is more a sign of weakness and a sign of bad things to come rather than a sign of strength. Unfortunately, there is no way to find out when the bubble will burst and when timing-wise the bad news will start to flow. But I think we have to be prepared that that biggest bubble we have ever seen in the modern history will eventually burst and bring down Chinese growth to much lower levels. Right now, the Chinese are reporting 7.5% real economic growth. I think in reality it's probably closer to 4%, and I could easily see that once the bubble bursts, we go down to 0 or something like that. So we have a recession type of environment. As you know, China has been the driving engine for the whole emerging markets because they import a lot of commodities. They have subcontractors around in all the satellite countries in Asia, et cetera, et cetera. So a slowdown there would accelerate the problems and deepen the problems that we already see in many of the emerging countries. That's why I think it is important that investors are aware of that problem. It would also impact growth in the developed world, of course.
I want to talk about what's going on in Japan after decades of stagnation. We have Abenomics that's going into effect. And that's supposed to, last year we saw GDP increase, we saw the Japanese market respond, their currency depreciated. But now, Felix, coming up in April, we have a major tax. So they're trying to stimulate their economy, but then they're putting a major tax. How does that work out?
Well, probably as a surprise to many, because with the 3% VAT increase, it's most likely that CPI inflation goes to somewhere around 3 to 4%, and we have wage increases of only 1 to maximum 2%. So that makes for negative real incomes or real incomes declining. And in view of the tax hike, there is pre-buying right now, and it will make this current quarter look very strong. But I fear that the next 2 quarters, the second and the third calendar year quarter, will be very weak and probably recession-like and lead to serious disappointments. And if that happens, it will probably be the trigger for the next program the Japanese will have to launch sometimes later in the year. I think, contrary to the consensus, that the yen is probably going to correct That means strengthen. After the weakness we have seen, we had the yen going from virtually 75 to 106 or so against the US dollar. And I think we could easily decline over the next 6 months to, let's say, the mid to lower 90s. And that is against the consensus because the world is short yen. And I think a lot of the hot money that is in that trade will probably need to reduce positions. I also think that the Nikkei will get affected in a negative way by that, and we'll have a shakeout and the correction in the stock market. After these corrections in the yen and in the Nikkei, I think we will probably see the Japanese government, together with the central bank, going for Chapter 2 in their big stimulus program. I think we will see much more aggressive monetary stimulation setting in sometimes later this year in the second half. And I think it is even conceivable that Abe, the government, provides some fiscal stimulus by launching some construction programs and things like that by the public sector. So I think later this year, we'll see Chapter 2 in that whole program, and then we could easily see dollar yen going from, let's say, 95 to 125. And if that's the case, then I think the Nikkei will have another big run up. And in local currency terms, this will be dramatic. Investors should understand that once they get in again after the correction, that they should play that only with their own currency hedged against the yen, because otherwise they would lose too much on the currency, probably all of what they could gain on the stocks.
Felix, what does all this mean? Earlier, you had mentioned that you thought we were getting in the latter stages of a cyclical bull market. Certainly, the Fed is withdrawing, and usually when they withdraw, they continue to withdraw until something breaks. In other words, monetary policy isn't precise. And when they start making adjustments, eventually it catches up with the market or the economy. How long can they continue to do this without the markets faltering? Number one. And number two, if the markets do falter, and let's say we fall back to 15 or 1600, would the Fed reverse course? And if they did, what would they do this time?
Well, those are two very interesting questions. We do not have any experience with tapering because it's the first time they do it. I do believe that this is a regime shift in monetary policy. It is like rising rates from -2% to 0. And while we do not know where it will hit, I believe that something happens because markets are pretty frothy. You know, markets have entered this year with tremendous optimism, the biggest optimism we have seen in many years. And it's a broad consensus. Everybody was very optimistic that the world economy would normalize and would improve and that corporate profits would run, that other asset classes like gold or bonds or cash were trash and unattractive, and therefore the only game in town is stocks. And at the same time, we are seeing many technical readings that show us the health condition of the market deteriorating. We see that momentum is deteriorating to some degree. We see that we are making less new highs among the stocks. We see that lesser and lesser stocks are trading above their 200-day moving averages. And we have recently even seen the stocks in the U.S. Trading above a 200-day moving average, breaking the lows of all of last year. That was an important message. And at the same time, we see indications that global growth against the consensus view is going to slow down. The best leading indicator for a global industrial production is really the relative performance of emerging market stocks relative to developed markets. And you can actually have a lead time of 6 months. And when you go back for the last 20 years, it has shown all the accelerations and decelerations of global industrial production. And when I look at that chart, I think we are in for quite some disappointments in the world economy. So you have upcoming potential disappointments in the world economy. You have a deterioration in technical terms of the global equity markets in the developed world. And you have the tapering and the withdrawing of monetary stimulus. I think this combination tells you that the upside is much more limited than the downside in the stock markets. And that's why I said at the Barron's Roundtable in early January that it's better to be more defensive now because some point this year we'll have a lower stock market. Now, what will happen? I think a 10% decline in the stock market will not change the Fed's tapering in any degree. But if we saw a decline of 20%, then I think they might postpone it, further tapering, or depending on the severeness of the decline, they may even turn around and change it and go to QE again. So I think they are data dependent and market dependent in what they do. Let's first see the decline. I do not know whether it's coming from a spring high. We have now a tactical rally in the stock market. It's unclear whether we will go to new highs and make a top sometimes in spring, later spring, and then have a more severe decline, or whether this is just a temporary interlude, a bounce back, and then a second phase of decline that goes deeper than most expect. That is unclear. So we have to play that tactically. And while I'm bearish medium term, short, very, very short term, over the next 1 to 3 weeks, I could see more bouncing attempts by the stock market until this is over.
So if you were, let's say, putting some money to work right now, in Barron's you talked about perhaps the GDX and also TLT or in Treasury. So almost like the risk-off trade. Is that the way you're playing it right now?
We have tactically closed our shorts last week at around the lows because we saw the ingredients of a good short-term low. So we closed some of our shorts. We also closed our shorts of emerging economic currencies like the Turkish lira temporarily. We think the fundamentals are still there and deteriorate further, and we have to open those shorts again. And we have bought some of the gold mining stocks and GDX, and we are looking to buy again on this bounce back in yields into U.S. Treasuries. That's correct. I think U.S. Treasuries will probably give us some safe haven protection factor if the decline continues, and I think the risk on the upside is relatively low. I think 10-year Treasuries near 3% are attractive, or 30-year Treasuries near 4% are attractive, and I think you will make money on them during this year, because sometimes during this year we should have a bigger decline of probably about 20% in the stock market. And when that happens, you can then sell your bonds and then buy stocks again.
Well, listen, Felix, I want to thank you for joining us here on the Financial Sense News Hour. If our listeners would like to contact you, I'd like to give out 2 websites. If you would like to find out more about what Felix does or follow his work, you could do so at www.zuam.ch or www.vicendaggroup.com. Those are 2 websites that you can follow Felix on. Felix, thanks for joining us on the program, and I wish you a healthy, prosperous year.
Thank you very much, Jim. Thank you for having me, and I wish you the very same. Thanks.
That concludes my interview with Felix Zulauf, one of the members of the Barron's Roundtable. Always like getting his perspective because it's more global. He sees things from a global perspective, not just in his own country of Switzerland. And once again, his comments that he mentioned in the Barron's Roundtable have been spot on. What has done well since the beginning of the year? Well, bonds and gold with the risk-off trade. But as he pointed out, with a fiat money system, we still may see some further highs or the markets may go up before eventually we may see that correction that everybody's talking about. And no matter what the Fed says about whether taper is tightening or not tightening, anytime you have a change in monetary policy, it shows up somewhere with catastrophic or booming events. When they're loosening, assets rise. When they're tightening, assets fall. One thing you can say for sure is they are now starting to withdraw some liquidity. And as Felix pointed out in that interview, it's beginning to show up as money begins to come out of the emerging markets, exposing some of their weakness, which we're seeing with rising interest rates, inflation, and depreciating currencies. So unlike last year, where you could stay fully invested and things went up no matter what the crisis, all of that money that went into markets last year was based on the fact that we were in a disinflationary wave and the fact that everybody was betting on a stronger economy, and along with the stronger economy, stronger profits. So if you want to watch out for trouble in the days and the months ahead, watch the LEIs. They'll tell us what's going to happen to the economy. If they start to falter, that also tells us profits will be faltering as well. And if the dollar strengthens as being one of the best economies around the globe, what does that mean for foreign corporations, many of them U.S.-based? They get a lot of their sales and profits from overseas. It means lower profits and lower sales as the dollar appreciates against other currencies. And, of course, that means earnings misses. And we all know Wall Street doesn't like when things miss. I'm Jim Poplava. Thanks for listening.
You can subscribe to Financial Sense NewsHour in the iTunes and BlackBerry podcast libraries or at feeds.feedburner.com/FSN. Find more information about our guests at www.financialsense.com/newshour. Friend us at www.facebook.com/financialsenseonline. For our on-the-go listeners, you can access Financial Sense on your mobile device at m.financialsense.com. The Financial Sense NewsHour is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the NewsHour each involve their own unique risk factors, which are not discussed on the show. Responses to listener inquiries are based on the personal opinions of James Poplava and do not take into account listeners' suitability, objectives, or risk tolerance. Financial Sense NewsHour and its parent company shall not be liable for any financial losses that result from investing in any companies profiled on or advertising with Financial Sense, or arising out of the use of any material on the NewsHour. Be advised that you invest at your own risk.
You've been listening to an encore presentation of one of our Financial Sense premium programs, which are available every week to premium subscribers only. For more information on premium subscriptions, go to our financialsense.com website and click on the subscribe link provided.